Everyone, please mute.
कोई काउंसिल
Hi, I'm really excited for this exclusive DSP session. I hope you all are too. So let's wait for a couple of minutes to begin with. Hello, everyone. Welcome you all to our YouTube live session on DSP Flexi Fund and its equity market journey over 24 years, exclusive for GEPL Capital YouTube subscribers and clients. Today, we'll be discussing about the Flexicap Fund. Before I introduce, can someone spotlight Atul Bhole from DSP Mutual Fund, who is going to be our speaker for today's session, and our moderator, Tushar Patil. Thank you for joining us. Atul Bhole has over 10 years of experience in fund management, currently working with DSP Mutual Fund as a fund manager. Thank you for joining us today, Atul. And our moderator, Tushar Patil, has over 8 years of experience and is working with GEPL Capital as a senior mutual fund research analyst. So without any further delay, let me hand it over to Tushar, who will brief about Flexicap Fund, followed by Atul, who will tell us about its 24 years journey in equity market. Over to you, Tushar.
Thank you so much, Sharmila, for the introduction. Apart from DSP Flexicap, Mr. Bhole is managing DSP Equity and Bond and Dynamic Asset Allocation Scheme as well. And these are consistent performing schemes too. As far as DSP Flexicap is concerned, it's beating category average returns across time periods and could generate 19% CAGR return since inception, with more than 2 decades of successful existence. So without wasting much time, I would like to hand over the session to Mr. Atul Bhole and know more about his extraordinary fund management style, including investment strategy and portfolio of the scheme, so that investors can take informed decision about investments. As markets are trading at all-time high now and valuations are rich. So over to you, sir.
Atul, you're on mute.
Sorry, can you hear me?
Yeah,
Yes.
better now.
Yeah. Thanks Tushar and thanks Sharmila for that introduction, and thank you to GEPL Capital for providing us this opportunity. So I would like to share a presentation which I have prepared for the meeting, and this presentation has a typical flow how the typically the investors or the partners like to go through. It has some market outlook, then about the portfolio positioning of the fund, how we are managing the fund in this environment, also about the portfolio construction, and the large part of the presentation I would like to devote on the way I select stock, the philosophy or framework behind selecting those stocks. That is, I think, very, very important for all partners and distributors to understand, because if you know that style or philosophy of a particular fund manager, then you can be confident at all points of time what kind of stocks he will buy and what kind of returns one can expect from the fund over a long period of time. So without talking much about this, I will start with the presentation. As we are actually highlighting the DSP Flexicap as an old fund offering, because you would have seen that there are a lot of NFOs going on into the market from the mutual fund industry side. We also did some NFOs in the past, and probably we will also do. But it is very important to highlight the existing fund which is doing very well, and it has a very good track record of almost 24 years. And most importantly, you can see the last portfolio or the latest portfolio, and also last 6-12 months portfolio, how the fund is managed, and also the stock selections, etc. So when you are buying an existing product, it is like buying a home in an existing locality or area. When you sort of want to buy a second home for your, say, next generation or children, you typically, or anybody typically prefers to buy the second home in the existing locality or existing city, because you know more about that city and locality. I think for the fund, while selecting the funds also, if the existing fund is doing well, then it is like buying a second home in the same locality. One should ideally be going into that second, the existing fund, rather than trying a new fund or going into a, like in case of home buying, into a completely unknown kind of locality or area. So I think because we know all these things behind this fund, what has gone into this fund and what is going into the stock selection, etc. That's why we are saying that whatever thing, the existing fund which is doing well, and all of you know that, then it's better to put into existing fund rather than trying new NFOs. There is a very big misconception or misunderstanding that NFOs are coming at 10 rupees, that's why they are cheap. It is not the case. Market gives the opportunity to invest the stocks to the existing fund as well as the new fund offering at the same price. I mean, we have to buy the stocks at the same price which is prevailing in the market. So going forward, the returns which will come from a new fund or a existing fund, they will be similar. And similar in the sense, they will depend on the market returns as well as the stock selection of the fund manager. So I think this is a big misconception that the 10 rupee NFO is cheap and you will certainly make money. It is not the case. And more importantly, in financial world, we have to judge the returns in percentage term always. And if you are getting that a 10 rupee NFO is going to 12 rupee, it is basically 20% return. And similarly, in the existing fund, if the 100 rupee existing fund NAV is going to 120, it is also 20% return. It is the same kind of return you are going to make from the NFO as well as the existing fund. So that is the idea behind highlighting our existing fund that the fund is doing well. We are not needing to bring out a new product into the marketplace. So with that clarity in mind, I would like to start with the outlook on the market. As Tushar said, the valuations are have gone up a lot in last one. Markets have given phenomenal return from that bottom of March 2020, because which was the COVID low. But even from this 16,000, almost 200 Nifty, I am constructive or positive on the market. I have been positive on the market for last many years now. I mean, at least 2-3 years, and I will maintain that view. The biggest thing is for last 10 to 12 years, if you see post the 2008 Lehman crisis, world over central banks are supporting the economies through liquidity. And with the COVID coming in last year, even governments have started to give fiscal stimulus. So when these two things are coming in, first of all, we avoided many of the unwanted kind of situation. I mean, because of COVID shock, a lot of companies or banks would have gone bankrupt, etc. But with the support from central banks and governments, that thing we had been avoided. We could sort of avoid those things. And because of, again, liquidity and fiscal stimulus, growth is coming back. And along with this growth, some amount of inflation is also making a comeback. Typically, people say inflation is bad and all, but actually, inflation up to a moderate level is actually a friend of equity or the corporates, because when companies increase their sales in typical year, they will increase by volumes by 10-12%. Like say auto company, say Maruti, just for example, they will increase by 10% in terms of number of cars. But when the inflation is there in steel, aluminium, and everything, they will also increase the prices of cars by 3, 5, 10%. And because of this 10% volume and 10% price increase, the top line growth will look like 20%. For 1 or 2 quarters, you will see margin compression, because taking price hikes is a gradual process, but ultimately companies get their profitability back. And hence we start getting a good profit growth also with this growth and moderate amount of inflation coming back. This inflation and growth is also very helpful to the governments world over. I mean, if you look at all governments, the debt to GDP ratio or the debt levels of all governments has gone up because of this COVID and all. But when the growth is coming back and inflation is there, government tax collection increase a lot. Government collects taxes on nominal value of goods and services. Like if again GST rate is 28%. Last year they had collected suppose 28 rupee GST on a 100 rupee article. If this year that article has become 120 rupee, government will collect straight away 6 rupees more, because they charge the tax on 120 rupees. So it is good for government tax collections also, which they can obviously spend in productive work like infrastructure or etc., which further sort of propels the economy. So this is good from that point of view also. So because inflation is coming back, and also there is huge liquidity out there in the system, many people have missed this rally. So I think though valuations have gone up a bit, market will not see a big correction. I don't think market will correct like 15, 20, 25%. 5-6% correction in equity market can happen anytime for any reason. We can't actually call out what will bring that 5-6% correction. But I think those corrections will be very short-lived, temporary, because liquidity is there. So people will come to buy those dips, because again, growth is coming back. So this is the global context, and this will be true for India also. We have seen that Indian markets are also following global markets. I think that thing will continue. We are very interlinked because liquidity is there and globalization has happened. The markets are behaving in more similar manner. So I think that will continue. If you come to India now, I think first wave we managed very well on a relative basis. I'm talking compared to many countries, we came out pretty well from the first wave. Second wave was more damaging for India, but despite that, I think we will sort of sail through even despite. And these 3-4 pillars of economy, like exports, consumption, infrastructure, real estate, I think they will help India coming out of this problem. Exports should do well because of the global growth, because global economy speaking, obviously our ability to export things or services will improve. And many of you will be aware of what's happening in IT industry. you can look at the IT stocks themselves, how sharply they have gone up. So there is a lot of demand from the global companies, and our IT companies are servicing that. Because of that, there is shortage of actually people, and the salaries are going up. So similar things are happening and will happen in textile, chemical, industrial machinery, small industrial machinery, because global growth is there. Apart from that, China plus sourcing is there. MNCs or global companies are started sourcing from other countries apart from China. That is helping India, and government is doing a lot of things in terms of PLI schemes, etc., which is sort of bringing companies into India to export, or actually the import substitution is happening in a big way. So this is good thing. But the biggest thing out of this is employment generation will happen in India because of this pickup in exports, be it services like IT or products like chemical, pharma, or textile. So employment generation for any economic parameter, when I look at, I just focus on what kind of employment will get generated rather than the total export, like 200 billion ka export hoga, 300 billion ka export hoga. That is not important. What is more important is what will be the employment potential generation. So I think we will see good result out of this in next 2-3 years. Consumption will also do well in India. A lot of people will debate how I am saying this, but I think because COVID has impacted a lot, many people in terms of jobs, and their incomes got impacted, etc. But I think equally same of families and people have actually better off, in the sense they saved a lot in terms of commuting, traveling, or hoteling, etc., etc. Many things, or spending on formal dresses, etc. So those things have been saved. So I think people, certain section of population, that it is slightly unfortunate thing that certain section of population is actually benefited in terms of savings, and certain section is got impacted because of COVID. But the first section, I think they will come out spending when the situation improves. So consumption will continue to do well in India, and particularly I think discretionary companies where people spend on home housing improvement or such kind of things, or auto, etc. Those the companies will benefit. Infrastructure is happening in India, metros, roads, irrigation projects, etc. happening. That will continue to happen and pick up pace, because in 8 months we will see UP elections, and then whole host of state elections will start, and in just 2.5-3 years we will approach the general election of 2024. So there will be a lot of push to complete the infrastructure projects which are ongoing before those kind of elections. So I think that tempo of will actually pick up further going forward. Real estate or housing market also will pick up. I think I have that strong personal view that real estate market will pick up. It is just a business cycle. I mean, business goes through ups and downs, ups and downs. This cycle has completed 10 years. 10 years, real estate prices has not gone anywhere. People's income would have gone up, and the interest rates are now lowest in after 10-12 years. So this is the perfect kind of recipe for real estate to pick up. So we are already seeing volume happening. I mean, lot apartment sales are happening, or even the individual house building is happening. I think that will pick up pace, and along prices will also start going up after maybe 6, 9, 12 months. So real estate will pick up. Again, the biggest takeaway from infrastructure and real estate pickup is employment generation. So if employment generation happens, everything will start rolling. The virtuous cycle will start for India. So I think in economics, actually, this is called as Goldilocks scenario. When growth is coming back, slight amount of inflation is there, and interest rates are low. That is the time when the economy does, or the stock market does very well. We have seen scenario during 2003 to 2007, when economy was growing, markets were going up, rates were also going up. So that kind of situation probably we are going to see in next foreseeable future. So given this context of global liquidity and global growth, and also India placed very well in terms of all these 4-5 pillars, very well placed. I think though markets have gone up, valuations are on the slightly higher side. Market or the valuations will sustain. and hence I don't see a big correction in the market. As I said, 5-6% correction can happen, and that will be used by the investors to increase the equity allocation. And actually, when the inflation is coming back, equity is the best asset class to deal with that inflation, or hedge against that inflation. So I think equity as an asset class will outperform all other asset classes. Though obviously we cannot expect returns of last year again and again. We have to normalize those returns. Expectations has to be trimmed a lot. They will not be like last year, but nonetheless, I think equities will outperform other asset classes. That is for sure. Maybe that quantum of outperformance may be lesser going forward. So this is the market outlook. If you come to the sectoral outlook, or the portfolio, how the portfolio is there. So I'm very bullish on or overweight on banking, private banks, NBFCs, and insurance companies. So you can see in the benchmark there is 31% weight into this sector, but I have allocated almost 36, more than. Now this is, I think, the last quarter was there. Their credit cost are also behind, so we are going to see huge profit growth going forward. I mean, in this quarter also we are seeing banks recording very big profit growth. I think that will continue. The valuations are very reasonable. Like in other sectors or stocks, we are seeing some exuberance, particularly on the IPOs or mid caps, small caps, etc. Valuations has gone up a lot. But if you look at these large private banks, certain NBFCs, or even insurance companies, valuations are very reasonable compared to their own history and compared to the market. So, and the growth is coming back in terms of profit. So I'm very bullish on this sector. Insurance offers a long-term opportunity, I think, to make money like private banks have created wealth for us in last 15 years. Private insurance companies can create that kind of wealth in next 10-15 years. So our penetration is low. They will launch a lot of new products, particularly on the pension or annuity side. They will also take market share from the PSU insurance companies. So they will continue to grow for a long period of time, and hence I think they will create a lot of wealth for shareholders. But one thing pertinent to note, that I don't invest, or there is no PSU bank in my portfolio, because I believe that I will cover that in terms of stock selection. But I think I have to have a confidence on the business and management, and which I get into private banks rather than our PSU banks. So there is no PSU bank in the portfolio. Then my biggest next overweight is consumer discretionary companies. Almost like 15-16% weight into these companies. As I said, consumption will continue to do well in India. Particularly if you look at the portfolio, last month portfolio, I have a lot of stocks from these discretionary categories, which I said will go into housing improvement sector, like of say Havells, Voltas, Polycab, KEI. Those kind of stocks I have, Asian Paint, those kind of stocks I have in the portfolio. Very well. But I think they will continue to do well because the pickup is there, as well as their competition got into a lot of problem, and that problem started actually in a big way from demonetization onward. Demonetization, GST, DHFL crisis, and all. The smaller players are not able to sort of manage things because of that, and these guys, the listed players, bigger guys, are becoming bigger and better. So we have to stay invested with such companies into virtuous cycle of growth. Then I am overweight on cement companies, cement sector. As I said, I am overweight on. I am bullish on infrastructure and real estate. But actually, if you see, there are very few companies investable in the infrastructure and real estate space. They have their own challenges in terms of business model, debt on the balance sheet, management quality, corporate governance, etc., etc. So even if you are bullish on infrastructure and real estate, sometimes you don't get right stock to invest and benefit. But cement gives that opportunity in an indirect way. So cement is required. You build it, building or infrastructure, metro, cement is required, and cement companies offer that opportunity to benefit from that build-up. The sector is also good. There is huge pricing power in the cement companies' hands. They increase prices as soon as the raw material prices goes up. utilization levels are at the higher side of 75-80% in large part of the markets in India. So I think these companies can do well in terms of volume growth as well as profitability growth. So I'm overweight on this sector. Auto is the overweight sector which I have increased the weight in last 2-3 months actually, but there is no auto company in my portfolio. This 6.7% weight we are seeing is actually all auto ancillary companies, and that too which service the global auto companies. So they don't service largely, I mean, some part goes into Indian auto also, but largely they service the global auto companies likes of these ancillaries are Motherson, Bharat Forge, Balkrishna kind of companies. I think the global markets will pick up first because the vaccination levels in US and Europe are pretty high compared to India. So they are already opened. Those guys have the people in US and Europe has a lot of purchasing power because government gave them a lot of help in during COVID. So their savings are also huge. So those guys will spend on auto ancillaries, auto companies, etc., auto cars, vehicles, etc. And these ancillary companies will actually benefit supplying to the auto companies. So hence I'm bullish on auto ancillary companies which are supplying to global players. I have no auto company because Indian auto company which are listed, we have not seen concrete electric vehicle plans from these listed auto companies. Until they show that concrete plans, I think I will will not be comfortable buying into Indian auto companies, because if they don't come out with electric vehicles on time, the competition will take away the market share. So that is a big risk. So I am staying away as of now from those auto companies. Of underweight sector or where I have allocated lesser money is basically oil and gas, metal stocks or power companies, etc. I will again come to that why I remain underweight into this kind of sectors, because I don't like the business model or government intervention, etc. So I will cover that, but I'm underweight. In the oil and gas space, I'm actually holding the gas companies which distribute the city gas distribution companies and not actually the oil companies. FMCG, the consumption part of FMCG, FMCG, the part of consumption basket, I'm underweight because I think these companies were not impacted because of COVID. They were doing well that time also. Right now also they are doing well. Good companies, everything is good. But I think the more money can be made on the discretionary side. That's why I'm more overweight on discretionary consumption companies rather than FMCG staple companies. Like FMCG basically means selling companies selling soaps, toothpaste, and oil and all those things. Uh, Technology or IT also I am underweight. I mentioned actually that the exports are doing well, IT companies are benefiting, and all those things. We are benefiting on the top line or the sales side, but actually these companies are not actually. There is a talent war happening in the IT companies. These companies are not getting right talent or people, and hence the salary increments are crazy for right people. So. Just a minute. Sorry, I got. Sorry. Yeah. So the I think the margins of these IT companies can come under pressure. On top of that, the salary hikes are happening. On top of that, these companies saved a lot in terms of traveling expenses because there was no need to travel to Europe and US and all. Also, visa expenses was not there, and the offices were also not functioning. So they saved a lot on. The margins will come under pressure for these IT companies. So that's why I have kept a little underweight on IT sector. So this is the sectoral positioning. In terms of the portfolio construction, so first of all, I don't take cash call. So you will not see cash in my portfolio because distributors or partners or you guys have advised the investors to put money into the equity fund. So I will not keep cash. I will deploy that cash into stocks, right stocks. And I think India has a lot of companies, good companies from across sectors, exporters, consumption companies, IT companies, pharma companies. There are many companies. So I can select 50, 60 good companies at any point to stay invested. So I will not take cash call. In terms of large cap and mid cap, generally I keep 60-70% large cap and 30-40% mid cap. So that 10% variation will be there depending on the outlook So last 6-8 months, I was running higher on the side of mid and small cap. I was almost 38-40% on mid and small cap. Those stocks did very well. Hence, in last 1 month, 2 months, I started exiting or reducing the mid and small cap companies, and I'm increasing the large cap. So my outlook on large cap is now uh, much positive than mid and small cap. Having said that, there are many good mid and small cap companies, just that the upside is looking a bit difficult from these levels. But having said all these things, I will remain in this 60-70, 30-40 band. So probably I will go to 70% large cap and 30% mid and small. But you will not see like 50-50 large and mid or 80% large cap, etc. That thing I will try to avoid time, because I think this kind of mix gives a better risk reward. This 60-70% large cap gives stability to the portfolio, 30-40% mid cap can add alpha to the returns. And also the risk is managed in a better way. So that is the way I am handling this large and mid cap proportion. And the last thing about the portfolio is typically you will see 60 to 65 stocks in my portfolio. Currently, there are 62 stocks. I'm not in favor of concentrated portfolio like just 30-40 stocks in the portfolio with 10 given to 5-6 stocks, etc. That is not my style. I think whatever amount of study we do or confidence we have on any company, risks are always there, and we can miss some of them, or they can come very sharp. Without knowing, they can come. So the stocks can correct 30-40%, or so this is called as price correction. The stock can correct 20-30-40%, and if I have like 10% weight, it will hit me badly. And the second risk is price correction. Price correction means the stock is at say 500 rupees, it will remain 500 say 2 years, 3 years. So that is also a big risk, because you don't earn anything on that amount. And if you are like again 8-10% in that company, that 10% will not earn anything. So that is a time correction risk. So by spreading out the allocation across 60-65 stocks, I think we can participate in more number of opportunities. And out of 65 stocks, if 5 stock doesn't go anywhere for 6 months, it doesn't hurt the portfolio. So that is the way I manage portfolio in terms of cash call, large cap, mid cap, number of stocks, etc. Now coming to the style or philosophy, and as I said, it is an important thing. So say 80% of my portfolio, I buy quality companies which are growing. I generally don't go into value stock or cheap stocks. Actually, most of the value stocks are cheap stock in my opinion. And some any stock, if it is trading at say 10-12 P in India, that means there is something wrong in the business or management, and then those kind of companies make money for the investors. That something wrong doesn't get corrected. It can happen in 1 out of 10-20 cases, but in the 9 out of 10 cases you lose money or don't make money. So it doesn't work out actually. But if you are investing into a good quality company which keeps on growing at consistently 10, 12, 15%, then you make good money out of such company, even if it is expensive at the beginning. So when I say good quality, means basically business has to be good. That means it should have a big opportunity set. Like I mentioned, insurance, they have a big opportunity, like 10, 20, 30 years, they can keep on growing. So that kind of thing. And also the company should have a good market share, or they are increasing their market share. They should have pricing power. And the things to avoid is basically those companies should have lesser capital requirement. So to grow, they did not put money into plant machinery, big money into plant and machinery, because if you need that kind of money to put in, obviously they have to take debt, and if the debt comes, further issues can come. So better avoid. Also, the company should good enough cash from their own business to grow. And the last thing is there should be very little government intervention, because we know, I mentioned that I try to avoid oil and gas, metal, or power companies, because government keep on interfering in their businesses. And if the government keeps on interfering, again, the profitability doesn't grow, or profits are compromised, and shareholders don't make money. So that's why I am underweight, or remain actually always underweight on oil and gas, power, and metal kind of businesses. I mean, they can be cheap, but they have been cheap for last 10 years. So I don't. Second aspect is management. Simple thing. The people who are running the business, they has to be good and capable, and they should understand what is happening, what changes are happening, and they should prepare the business for those changes and benefit from that. And also, I don't like companies or management which try to do many businesses through one company. I want my companies to stay focused around one or two businesses and grow in those businesses. I believe that any person can have expertise in one or two areas. I mean, I cannot be doing many things at a time. We have a right to win in one line. So similarly, companies also have right to win in one or two lines. And if company things, they there can be failures that comes on the balance sheet, or many things happen. So such companies may not generate wealth for shareholders. So better to avoid again. So also I like to avoid companies which dilute capital again and again. So when they dilute capital means raise money from the market, what happens is company can grow, but your share base or number of shares also grow. So the per share earning or wealth doesn't grow, and ultimately you don't make money. So I avoid these things also. And last thing is growth. Growth should be there. Without growth, problems start creeping in. Like if there is growth, you can continue investing into the distribution. You can expand the company. You can invest into advertising and promotion. You can motivate your employees through promotions, etc. So it is a virtuous cycle. These things will get further growth. But if there is no growth or absence of growth, employees will be demotivated. The company itself cannot invest into business. So if they are not investing in employees and business, the growth will not come back. They will keep on going down, down, down. So again, can't make money in such stocks. So these things are very important and very commonsensical. I mean, if you think yourself, these are very common things. If these things are there, companies make money or the stocks make money. It is very simple. And I mean, it is there in my portfolio also. Fact sheet. If you look at HDFC Bank or Kotak Bank or Asian Paint, they were always expensive, but they make money because they have good businesses, good management, and they kept on growing. So very simple framework. And we have to investing is also simple. Like it is like buying anything. I mean, if you buy a say 1,000 rupee chappal compared to say 200 rupee chappal, that 1,000 rupee chappal will obviously much better and stronger and will last for 2 years. The 200 rupee chappal might break down in 3-4 months in the street only when we are walking. So it is not that expensive. Buying expensive means you will not get anything out of it. Basically, we have to look at while buying what is there in the business and management, and then if you are okay with the price, then you can buy. Whether it is high or low, that should come later. But you should start with the business and management. I don't buy anything because it is cheap. First, we have to look at business, look at management. If you like both of them, then look at valuation. That is my approach. So as I said, 80% portfolio is through this approach. 20% of the time I will look at some short-term opportunities or tactical opportunities. Like I have Tata Steel in the portfolio. Like I don't like the company or business so much because it's capex oriented. Governments keep on interfering, and the company also a lot of debt on the balance sheet. The ROEs are not there, but the steel cycle has turned, so they are reducing the balance sheet. The management is good, Tata Group, so I bought it. So the main thing when I buy this tactical or look at this tactical stock ideas is basically management. I don't look at business. I mean, it is important, but the management is the main thing. There also in such opportunity also there should be a minimum kind of a level of management which should be there. Then only we can go into such tactical stock ideas. So the other things I played in 1 year is basically Tata Power. I bought at a price, I sold at a price. Trent Limited, I bought at a price, sold at a price. All three Tata companies. Currently in the portfolio, Bharti Airtel is there. It is again a tactical idea because business is very, very capex intensive, and government keeps on changing or interfering into those telecom company businesses. So they don't generate ROE and cash. So I don't like that business much. But the management is good. I mean, the company survived itself is a big thing. I mean, 10 companies went out of business and this company survived itself is a big thing. And now, because there are only 2-3 guys or 2-3 companies, they will supposed to take price hike and the stock should do well. So that's why I have bought it at a price, and I will sell it also at a price. I will not keep it forever like HDFC Bank in my portfolio. So this is the way I look at tactical opportunities. And this is the way I manage portfolio. 80% very good quality companies growing, where I will rarely book profit. Only when the price goes out of whack, like I mentioned, some of the mid cap companies I exited or trimming. Those companies are good, very good companies, but they have like 100% up in 6 months. So hence I am booking profits and putting into large cap. But otherwise, I would have liked to hold on to those quality companies. But currently, I am booking. But in tactical, that will be obviously a short term calls. So this is the way I manage funds, and this line is important. I can take valuation risk in buying these core portfolio companies, because if you see last 5-10 years, there are so many challenges coming again and again. Uh, uh, Everywhere, like technology is making a lot of changes and bringing out newer and new things into the businesses. Regulations are changing. So actually, it is very difficult to continue or manage the business. So such companies. Hence, I think it is better to take the valuation risk. I mean, you buy expensive things, you buy expensive companies, that is okay, but it is not good to buy a business or management where you are not confident, because that doesn't pan out well in the end. So this is the way I look at selecting the companies. This is my framework, and this I have been following for last many years since I started managing money in this company as well as my previous organization. How do you manage risk? So I can answer this in a typical way. There are many things, quantitative things. My team helps me. The risk department is there. But I think the best way to manage risk is knowing what you are buying. Know what you are buying, the kind of company you are buying, and if it is a good quality company and growing, I think automatically risk is taken care of. Next thing is, as I said, I spread it across 60-65 stocks. So that is the other way of managing risk. So this is the way I think risk can be managed in a best way, rather than looking at those ratios and all those things. Those don't serve any purpose. These are some fund attributes or ratios, etc. We can, you can look at later also. This one thing is important. The active share of it is 64%. 64% means 64% of the portfolio is different than the index, or the say in benchmark is Nifty 500 is my benchmark. So 64% of the portfolio is different than the benchmark weight. That is because many of the Nifty stock doesn't fit into my this framework of business management and growth, so I don't buy them. I will buy into this portfolio what fits my framework and there is return potential. I will not buy anything just because it is an index. And anyway, if you want to buy those companies, you can invest some money into index fund or ETFs. When you are investing into active funds like this DSP Flexicap Fund, I think we should look at these active ratios. If somebody is having all those 10 stocks in Nifty in his fund as well, then there is no point in buying that fund. So that's the way I think when I manage the fund in an active way. This is the return, like Tushar mentioned about like 80 since inception return 80 times and benchmark returns at 29 times. It is the 20% CAGR, etc. You can again look it later. The returns, how it has captured the upside and how it has avoided the downsides, etc. Those ratios are given on this chart or on this slide. And this is the last slide, basically something about my Tushar, this is already covered in the introduction. But this thing I want to say that basically all employees are DSP, of employees of DSP mandated to invest into DSP funds only, DSP mutual funds only. And in my case, large part of my financial savings are into equities, and all that equity exposure is through my funds. DSP Flexicap Fund and DSP Equity and Bond Fund. So whatever I just told you, all my money is following that. So I think that can give you a lot of confidence. So I will. So this is the end of my presentation. we can take questions now. I'm sure there will be some questions, so I can. That will be a better way to have some interaction. Thank you.
Thank you so much, sir, for your detailed presentation about the FlexiCap scheme and outlook about the equity markets. Guys, if you have any questions, please type in the chat box so that Mr. Bhole can answer them. So, sir, we have already some questions, and the first question is: auto sector is more affected due to the semiconductor scarcity. So, what's your view on that?
Yeah, so I think this semiconductor scarcity is going on since last 6 to 8 months, and probably it will continue for next 3 to 6 months again. I mean, 1 or 2 quarters can go because of this semiconductor scarcity, but the situation is improving. Those companies are coming back. Actually, two companies globally got impacted, one because of floods and one because of some other reason. But those companies are now started to come back on stream, and also there was shortage because globally there was rush to buy consumer durables as well as autos. Like these chips goes into washing machine, fridge, LED, TVs, and everywhere. So there was demand bunched up in a short period, and also there was supply shortage. And probably in 3 6 months the situation will come will normalize. And the good thing is this demand doesn't just go away. This demand is there. When the semiconductors or the chips will become available and the autos will be made, those companies will sell those things. So I think it is a temporary situation, and that's why actually I said that I increase auto ancillary companies which are supplying to global auto companies, because this is the, I mean, such is the time that you can buy good companies. These are, one should be clear that these are temporary affairs. This is a temporary affair. It will be out of our way in 3 6 months, and then the companies will come back in a big way. So I think this kind of situation will actually has to be actually used to buy into those companies, and that's why I have done. Or I think that will pan out that way. So this is the time to buy such companies actually.
Okay. So the second question is related to real estate sector. So it's a positive sector. So as per your present. So can you please throw some more light on the sector and your view on the real estate, please?
Yeah, as I said, any sector, any economy, any sector in any economy goes through ups and downs or business cycles. So we have seen in last 30 years also, if you see, real estate has gone through lot of cycles, many cycles. From 1998 to 2003, the sector was sleeping. From 2003, it started picking up, and 2005, 6, 7, 8, it was like maximum. I mean, the peak period of that sector. From 2012, it nation because prices went up a lot, and last almost 9 10 years prices has not gone anywhere, and the interest rates have come down to almost 7%. The last time we have seen 7% housing loans were in 2006 or 7, I guess. So we have come back to that situation where the prices have gone through a correction, interest rates are lowest, so it makes sense to buy a house. So if you say look at a 2 BHK home in say any city, roughly you can calculate that the difference between rent and EMI has narrowed. If somebody is paying say 25,000 rupees rent, he can buy a house by paying say 40,000 EMI, which would be say earlier can be say for 50,000. So that difference is compressing, and when the difference between rent and EMI comes down, people starts making those decisions of buying homes, because it is very clear that rent is an expense and EMI is like our SIP. When you pay that EMI, actually you are building an asset in terms of that home. So people are not aware that rent is expense and EMI is like a SIP, but those kind of decisions happens automatically. We need not explain these things to people. So I think we are coming to that situation. So hence I think we will see, and we are already seeing volume picking up in last 6 7 months, and I think that will continue. In addition to that, if you see last 5 years were very bad for the many developers or builders in this sectors. So there has been hardly new launches happening. So they were actually completing whatever projects they have started in 2010, 12, 13. New launches didn't happen. So there is no inventory in the system now in many markets. whatever inventory was there, it is already sold out to a large extent. Little inventory is remaining now. So hence, I think and I believe that the real estate will start now in maybe 6, 9, 12 months again, and we will see volume pickup as well as it will follow. It will be followed by pricing growth also.
Okay. So the next question is related to the banking. So you are bullish on banking sector, but in your portfolio, PSU banks are not there, even though the numbers are coming good now in the results. So any reason for the same?
Yeah, as I mentioned, I told that upfront that I don't have any PSU bank because I think, as I said, one big thing I look at is in my businesses or companies, the government intervention has to be lowest, and also the management has to be the best or one of the best in the industry. So if you don't find these things in the PSU banks, they again and again keep on going into problems in terms of asset quality, etc. Their profitability, though you would have seen the absolute profit of the bank, but profitability in terms of percentage is very low. Like in banks, we look at return on asset ratio. That is the best way to judge a bank. In PSU bank case, it is just about 0.6, 0.7%. In private banks, it is 1.6, 1.7%. It makes a huge difference. It is double or triple the PSU banks profitability for private banks, and hence these banks have done so well in last 15, 20 years. And as you go forward, I think in terms of technology and products launches, etc., these private banks are way ahead PSU competition. So the deposits are moving from PSU banks to private banks. Deposits give cost of fund advantages to to any bank, and private banks are garnering those low cost current account and savings accounts, etc. So the cost of deposits is very low. Their cost of operations is also very low because they don't have to pay pension and all those things, or they don't have to pay according to the not exactly pay commission, but a similar thing is there in the banking sector. So they can manage their cost in a much better way. So almost at all levels, starting from the revenue of the bank or the interest which banks get, banks pay, the OPEX ratio, etc., private banks are doing much better. So I think, and the credit costs are much better managed in the private banks. So I think I will stay invested with private banks. There are much good, better opportunities to capture in private side than PSU side. So that's the way I would look at it.
Thank you, sir. So the next question is related to metal sector. The guy is asking, it's the flavor of the season, but there is hardly any exposure in your portfolio. So any reason? They want to know more about that.
Yeah. So as I said, in these three sectors of oil and gas, metals, and power side, typically you will see my portfolio has underweight positions. I mean, you'll see hardly any companies from this sector because as I mentioned, their business models are very risky in terms of if you want to put up a steel plant, aluminum plant, you have to take, you have to put huge capex. When you do that kind of capex, you need to take debt on the balance sheet, and these metal prices are always cyclical. Now we are experiencing a peak kind of cycle in metal prices, but obviously down also. And when you have a debt on the balance sheet, when the prices goes down, you fell into a problem. So this sector is cyclical, very capex oriented, and governments also keep on interfering into these businesses. The ROEs of these companies are hardly 8 to 10%. So all these factors which go into going into making a good business model are sort of not there into many of these metal companies, or cannot be there into many metal companies. These are basically cyclical stock. And I have just one metal company in my portfolio, Tata Steel, because as I mentioned, how I play tactical calls or tactical opportunities where I have some confidence on the management, then only I enter into such company, and there has to be a positive thing happening in terms of trigger or anything like that. So that's why I saw this metal cycle and I bought this company in the portfolio. But by and large, I try to, I don't go into this kind of sectors or companies because they give returns in a very sporadic way. These companies will do well once in 3 year or 5 year, but there are many companies in India, like private banks, insurance, etc., which keep on giving us 15-20% return every year. I think those kind of returns are much better than getting say 50% return in 1 year. So that's the way I approach stock selection, and hence metals are underweight in my portfolio. It is a tactical position. You may not see that stock after 3-6 months if it achieves the price target.
Mhm. So the next question is related to market cap allocation. This large cap allocation, the question is, are you going to keep the large cap allocation above 50% always?
Yeah, actually, it will be more than 60% always. As I mentioned, my large caps will be around 60 to 70%. So it will vary in the range of 60 to 70, and mid caps will be 30 to 40. So, right, it will be more than 60 always. Yes.
Okay.
As I mentioned, that slightly higher allocation to large cap of say 60-70% gives stability to the portfolio, because most of these large cap in my portfolio are consistently growing companies, very stable businesses, so they provide stability. And 30 to 40% mid cap, depending on the outlook, they provide a bit of a alpha to the portfolio in terms of higher returns. So this is the way I allocate money into the fund always.
Okay. So what's your view on QSR as a segment? And second question I will add on into this, like Zomato is a loss-making company with high valuations like Asian Paints. So do you think Zomato is also the same story like Asian Paints?
So on the QSR space, I think company, I think most of the other companies are still struggling in the marketplace in terms of getting their business models right. They have to have a certain size, scale, as well as the pricing has to be right. And they are not, many of those companies are not getting it right. So, except one company which is very expensive, I think there are challenges in the QSR space. So, people are excited because of COVID happening, and also obviously these companies got benefited because of that. But one has to remember that these are temporary things. Things will normalize after 6-9 months. People will start eating in normal hotels, etc. So I think it is a big opportunity, multi-year opportunity. But at present, the valuation for that one company is very high, and others are still struggling. In terms of this online platform, like the company which got listed now, I don't think such kind of companies can be compared with Asian Paint. I mean, I have Asian Paint in my portfolio, but that is a very, very strong franchise. It's a large, 80-year-old company and making money, and they never lost money in their life. So it is not a comparison at all. And in this case of new IPOs which are happening, I think there is a lot of excitement. There is a lot of extrapolation happening because some company did well in US or China. It will do well in India as well. I think also the business model to sort of, when they will make money and how much money they will make. It's a lot of questions are there around that, and a lot of this valuation is on the basically Excel sheet. It's not actually on the ground of business. So I'm not very keen on these kind of new listings. I have a lot of apprehension. I think we have seen that basically private equity guys or venture capitalists invested at higher and higher valuation, and lastly they have come to the market even selling at even higher valuation. So it's basically, if you have heard the Ponzi scheme, or they are trying to, it is called as they're trying to, chipkaw the topi to next get a full. It's a get a full theory which is going on. So I'm not excited about these new listings. I think it actually, when I said about the market cap, I think these are some of the risks I should have mentioned. Some of these online companies or new IPOs, or some of the small and mid cap companies, or at a global level, cryptocurrencies. I think these are the 3-4 pockets where there is a lot of irrational exuberance happening and to the market. But anyway, this is in a pocket. It is not at the overall market level.
Okay. So the next question is, what's your view on internet companies as a segment? Do you always look at only growth or profit as well?
It has to be profitable growth. I just don't go behind growth because I mean, we will come to know about the growth when these companies try to profitable. When they charge, when they start charging to people or charging higher to the people, we will come to understand how fast they can grow. They are growing very fast because a lot of discounts and rebates and cashbacks and all those things, and they are not making money, they are burning money. But we have to see whether they can keep on growing at 25, 30, 40% for next 10 years
Mhm.
when they want to become profitable. I don't think that that will be the case. When they want to become profitable or they want to make decent money, I think this growth will collapse to at 10% or something like that. So I think I always have to have profitable growing companies. I don't want this 25, 30% growth. I am happy with 10, 15, 20% profit growth. Sales, anyone can get sales, but I think its profits are more important, and the growth in profits is more important to make money.
Okay. So the next question is Reliance Industries in your portfolio. So any particular reason adding the stock in the portfolio?
Actually, it is not there in the portfolio, and I never had this company in my portfolio in last 5 years, because when I said business management and growth, and I mentioned about capital allocation, I don't like companies into multiple lines of business. Hence, you will see actually not this other companies in the index, big companies which are doing multiple businesses. They are not there in my portfolio.
Uh, okay. And so what are you expecting in next 24 years? The fund can deliver the returns. Last 24 years, 19% CAGR returns.
Yeah. So I think we cannot sort of take this past return to replicate. That is not going to happen. In any economy, the equity market returns will be obviously has to be linked to the risk-free return of that economy. So when this 19% return came in last 24 years or so, you will remember that last part of last decade or even before that, our interest rate used to be 9-10%, or the 10-year used to be at almost 8% at some point of time. The PPF used to double, or the this Kisan Vikas Patra, etc., used to double in 6 months, 6 years, etc. So that was the period, and the equity returns will be obviously slightly higher than the 10-year GSEC or the risk-free return rate in the economy. So which is currently like 6%. So we can expect a 4% higher return from the equities at, because that is called, that higher 4% is basically called as equity risk premium, and that is the kind of returns we can expect. So if in future, say after 10 years, India's 10-year GSEC goes to 3%, we can start expecting 7% return from equities. So these equity returns are always linked to risk-free return or fixed income returns in any economy. And because we are taking risk of investing into equity market, we get that 3, 4, 5% extra. On top of that, we can get 1 or 2% extra, depending on the stock selection of the fund manager. So this is the way we have to explain to the investors what kind of returns we can expect from equities.
Okay. So I think there are no more questions now. So in case, guys, if you have any questions in future, you can always reach to us, or you can mail us the queries and we'll try to resolve it ASAP. And thank you so much, sir, for answering all these queries and giving us a detailed presentation. I'll hand over the session now to Sharmila. Over to you, Sharmila, now.
Thank you, Tushar.
I thank you, Atul, for taking us through the journey. 19% CAGR is really incredible. So we would like to thank Kunal for making this YouTube live session successful one. Can someone spotlight Kunal, please?
Thank you to for arranging this. And it was a pleasure addressing your team, your investors, and your advisors through Atul. Thank you, Atul. Thank you, Tushar, and thank you, Rupesh, and thank you, Sharmila, for
Thank
arranging.
you, team, and all the best. Thank you.
Thank you all our YouTube viewers for tuning into this live session and subscribing to GEPL Capital YouTube channel. Thank you, Tushar and Rupesh, for making this happen. And a very big thank you to our digital team. Stay safe, stay connected to GEPL Social.
Thank you.
Thank you.
Thank you.